Hi everyone, welcome again. As usual, I'm here to share with you my views of the market, both technically and fundamentally. And as usual, I would start with the macroeconomic calendar, sharing it with you. And before starting to comment about the key events that we have ahead or we had already, I would like to take a word and said that, of course, the market is now being led not only by central banks, but also by political woes, right? There are two big events going on. One is France presidential election, the other, the Brexit. Both are having a strong weight in the market and the market movements. And of course, the Fed's decision to raise rates, right? But keep the tightening pace slow, right? Showing that they are in no rush to rise rates farther than what I have said earlier in December, uh, has put the dollar under pressure. Regarding French elections, we had the first presidential debate late Monday, right? And the second runner, which is Emmanuel Macron, seems to have stood victorious out of a debate, right? Beating Marine Le Pen, who is still the favorite candidate within polls, right? But Marine Le Pen favors an excision from the euro area once the Brexit, right? So that implies risk for the common currency, and therefore, when Macron beat her in this first presidential debate, that anyway has no long-term meaning. Uh, well, that favors the common currency. And on the other hand, and about the UK, it's worth to mention that Theresa May has uh, finally put a date to Brexit. Right, we are uh, having the Article 50 of the Lisbon Treaty being triggered on March 29, right? And that will be the beginning of a 2-year process, which implies negotiations between the two parts. One side the UK, the other side the euro area, right, to reach an agreement, right, for further commercial and relationships between both economies after the UK leaves the euro area. At this point, up to this point, Theresa May got the center stage. She was the one who said what she wants, what they would choose, if they want a hard or soft Brexit, if they want a trading deal, a free deal, a whatever deal. The fact is now the ball has rolled to the contrarian field, right? The power is now in the hands of the euro area members, who at the end will decide what it will be the cost for the UK. So, as we have seen over the past couple of weeks or even months, I do believe, announcements regarding the Brexit were triggered maybe an opposite effect in the pound, which means the pound rose after Brexit headlines. Now that the power is in the euro area members' hands, I do believe that every headline about Brexit coming particularly from them, right, will have the opposite effect, right? It will be a hard deal. I'm pretty convinced of that. And we'll probably see the pound easing further. What's saving the day today for the pound is inflation, which has rose far beyond expected. And this came after 1 week after we have the Bank of England meeting, where we have one member voting to raise rates, right? Christine Forbes. I know everyone in the media disregarded her her decision to raise rights, her vote, right? Because she's leaving the MPC later this year. But the fact is that the rest of the voting members within the Bank of England are not far beyond her, right? They are all concerned about rising inflation. They are all concerned about the pace inflation is having towards the upside. And today we get a confirmation that it's more than likely that in the next Bank of England meeting, it will be not only one member that will vote for a rate hike, right? And that will put the United Kingdom one step closer to tightening its monetary policy. And that's, of course, it's what's backing. the pound. Anyway, let's go to the numbers, right? The numbers we got. Honestly, there was not much actually relevant going on beyond the inflation in your case. Sorry, late late Monday, early Tuesday, the Reserve Bank of Australia released the minutes of their latest meeting. The fact is that they did not add anything new to what we already know. And in fact, it was slightly dovish because the central bank is concerned about rising house prices and a probable bubble in the housing market, right? So it was a modestly dovish statement, which anyway was not enough to push the Aussie dollar below the 0.77 level, which is for me a big line in the sand. We are struggling around it. We are going to talk about it now. Anyway, as I was saying, inflation was pretty high. Uh, Core yearly inflation up to 2.3% in UK, right? 1.8 was previous, 2.1 expected. Indeed, a really big number. And what I was also watching is that despite producer prices miss expectations, they also continue to rise, right? And that the previous numbers suffer revisions, modest revisions, not much relevant, but output prices were revised higher and rose as expected. So overall, and retail price index, sorry, also huge advance in here. So overall, these figures are confirming that inflationary pressures in the United Kingdom are way too high and that the Bank of England may be forced to rise rates. Okay. Anyway, for the rest of the day, I don't actually see nothing really relevant. We can get some headlines from um, Fed members speaking, right? But to be honest, that won't be enough to revert the dollar's negative momentum we are seeing these days. So further dollar losses are expected. The Bank of Japan will also release the minutes of their latest meeting, but I don't expect any much more effect because most of what they would say it has already been said um, during the monetary policy decision last week. Okay, for tomorrow, the only relevant piece of data that again will be able to turn on the dollar's negative momentum housing starts. Nevertheless, I will be taking a good eye to these numbers because housing data is actually more relevant than what usually calendars, macroeconomic calendars said, particularly after the decline we have seen in the last month of 2016. Okay, on Thursday, attention will turn back to the UK with retail sales. I believe this is the most relevant report. Um, Sales had dropped in the previous month, okay, clearly indicating how inflation is affecting consumption in the United Kingdom. So all of these Brexit woes, right, at the end will put the pound under further selling pressure, particularly if these numbers are disappointed. We are expecting an upward move in sales, and I'm not sure if we're going to see that. In the US, more housing data, and another Fed member, nothing much to add about it. On Friday, things turns a bit more interesting with the PMIs, manufacturing services, composite PMIs for the euro area, and durable goods orders in the US. To be honest, I would expect the market PMIs to be overall positive and continue to indicate that the euro area is growing. So any reading that matches this particular ones or goes the expected, I mean, right? Or above it, right? Uh, Could probably fuel further the euro rally, particularly because we're talking about preliminary readings. So these are usually surprises for market players, right? We have the revisions later in the month, and those revisions are not as relevant in these preliminary numbers, okay? But I would expect particular, of course, attention with focus in German and the euro area numbers. And if the numbers came as expected or above, the euro will probably continue rallying. And as I said, in the US, durable goods orders are usually uh, uh, quite relevant, sorry. As you can see, the previous month has been already boosted modestly higher, but it's still lagging. This is a sector, right, that is still showing no much progress, and uh, it will be another shoe, I mean, another stone in the dollar's shoes if these numbers disappoint, because that will mean that the U.S. economy is not producing as much as market will uh, want, right, to start speculating about the possibility of a faster pace from the Fed in the hike rates. Okay, finally, at the end of the week, we have the market manufacturing services and composites PMIs for the United States. To be honest, these are not as relevant for me as the European ones, okay? Because the US economy has been doing more or less good for long, so these numbers won't affect the market, won't affect the pairs as much as the European ones will be, unless, of course, we have strong divergences in the outcome and the market expectations, okay? Anyway, let me change the charts and see what we have there. Okay, we have a lot of action going on, particularly within European currencies. The euro is nearing a critical resistance. I was watching these charts earlier today. This is the euro dollar daily chart, and as you can see, the pair is trading above 800. This 820 level stands for the 50% retracement of the post-US election decline after bottoming at multi-year lows. Early January, the pair attempt to recover this level but was rejected at 828. So I'm seriously watching this 2030 region for today, as if the price settles above it, it will have scope to advance farther, right? The next probable intraday resistance will be 870 short term, I mean, but the pair is en route to 930, which is the 61.8% retracement of the same rally. I was also taking notice in the daily and in the weekly chart, right? Take a look at the weekly, that the price has broken and extended above its 20 simple moving average, and technical indicators in the weekly have finally entered positive territory with strong upward momentum for the first time since September, November, October last year, right? So overall, seems the euro has more room to advance. Honestly, at this point, I can see a strong barrier around 110, but well, we need to wait and see how the price behaves if it manages to break this first Fibonacci resistance and extends farther, right? And we're still not seeing much more. And of course, we have German elections, the French elections, right? We have just a presidential debate, but I'm not expecting much of dollar strength. That's what it's helping also the euro to advance and the rest of the currencies, because the dollar is the one in trouble these days. Okay. Anyway, and from here, my immediate support comes around 735, which was major resistance for a lot of days and turned into a support last past week. Now the level to watch, because we are seeing that buying interest is surging and approaches to this level. So watch that level. And to be honest, if it gives up, I would like to see a price below 690 to talk about a probable interim top and downward corrective movement that could send the pair back down towards the 640, 660 area. Honestly, not seeing that bearish move not coming, but well, there it is. For the pound, I feel less confident about this recovery, although everything in the technical picture is telling me that the pound will probably continue advancing, right? We are above the 38.2% retracement of the January rally triggered by Theresa May at 24, 25, 24.30. So that's my immediate support. The pair has stopped for today at 24.70. So above this 70.80 region, I could expect it to extend its advance up to 25.13. However, I do believe that the risk in here coming from the Brexit and with Brexit starting next week, I'm not sure if it's worth holding longs for beyond the intraday trades we can get from this kind of movements, right? Anyway, the technical picture in here is bullish, and 25, 30, 40 seems a probable target. If we came above this, the pair has scope to extend up to 126, okay? As I said, that 24, 20, 30 level is the immediate support. Below it, the downward corrective move can go down to 23.60 right here, right? And it will take a break below 23.45 to deny the bullish potential and see the pair coming back and setting pressure, probably moving back towards the 22.50 region, 22.40. But overall, the pound seems quite bullish. Uh, it's like all the three, and the euro, the pound, and the USD are at key resistance level. And if I have to be honest, I rather at this point today I prefer the euro, because the pound has the huge risk of Brexit and going into the OC. The OC has been unable to rally or sustain gains beyond the 77 level for uh, over years, over 2 years almost, right? Take a look at this chart. It has been unable to really trade above 77, right? With sustainable moves, mid 2015. Okay, we have a couple of spikes beyond the level, but gains were not sustainable. So it looks a bit complicated to go long at this level. It's also for me, although we can't deny that the pair is bullish. uh, anyway, dollar weakness could favor such a movement for the coming hours. And what I noticed so far this week is that pullbacks towards 77 have attracted buying interest. So 77 seems to be the floor, 76.90, right? And well, we topped at 47 early Monday. So that's the level I'm watching, a break above 50 to confirm further gains. In that case, 77.90 and 78.30, which is 2016 high. It's my main bullish target. I know the Reserve Bank of Australia feels uncomfortable with the OC at current level, but the market does not care much about how uncomfortable or comfortable central bankers are. The market gets into a trend, it goes. So concerns coming from the Reserve Bank of Australia are not my concern. Okay, my concern is that the pair has been unable to hold gains above the 77 mark for over a year and a half. So that's what I'm taking care of these days, trying to move with short, well-limited stop losses. Anyway, the downside for me remains needed. To be honest, 76.60, this area is the one to break to talk about a downward extension in here. Not seeing coming today, right? Probably not tomorrow either. I would love to see the pair breaking higher and testing that 78.30 uh, yearly high. Okay, and for the dollar Japanese yen, ever since the week started, the pair has been unable to regain the 13 level. We have a couple of attempts, but it's also refusing to break lower. Right? It's just in consolidative mode. Not much of definitions in here. What it's puzzling me is the fact that positive US data, intraday positive data, it's unable to trigger some spikes in here, right? So that's quite bearish for me, despite the lack of directional strength we are seeing ever since the week started. I'm looking for a test of 12, right? 12 is a major long-term Fibonacci support, right? It's the post Abenomics era, 38.2% retracement, as you can see. Where the level has held pretty well ever since this year started, but still, I do believe that the risk of a break lower is still big in there, right? Below 12, 1160, the pair bottom of 1160 multiple times earlier February, late January, right? So that's the level I'm watching. If the 1160 area gives up, then that should confirm a bearish extension towards 110, which is the lowest I can see the pair going for now. Okay, And on the other hand, as I said, approaches to 13 has been attracting selling interest. And if you take a look at this for our charts, for others, sellers are waiting around 1350, right? So it will take an advance beyond this area to ease the bearish pressure and see a recovery, which the next short-term resistance at 14 and this 1455 region, which is the next Fibonacci level. And as you can see in this intraday chart, a major technique static resistance, right? Price fell around it multiple times. Oil prices are recovering a bit today, but still looking quite bearish, still holding below 50. There were some comments yesterday about the possibility the PEP is discussing the possibility of extending um, its output cut program into the second half of 2017. But they also remarked that they will need non-OPEC countries' support, right? And we are not sure they will get it. But what's really waiting on oil prices is the increasing U.S. production. Despite we have a small drawdown in inventories last week, the fact is that the U.S. stockpiles stand at record heights. More rigs are drilling oil. There are more active drills every week. I believe that we have an increase for 9 weeks in a row, according to Baker Hughes Friday's data. So overall, the strong pace in increase in U.S. oil production is outpacing or offsetting, better said, whatever effort the OPEC is doing, right? Following this daily chart because the price is unable to recover above this moving average, the brown one, which is the 200 simple moving average, right? And I'm also watching how the 20 has crossed below the 100 with a sharp bearish slope, all of which is telling me that the commodity will likely remain under pressure, at least from a technical point of view. Uh, Now, having recovered modestly today, I believe that the recovery is more due to the absence of news than to some oil strength, right? Mostly it's due to dollar weakness. As you can see, the recovery is pretty shallow because the risk in here remains towards downside. A recovery above this 50 to 30, 50 10 region could see the commodity attempting to regain further ground, but to be honest, 51 should cap and the risk, as I said, remains towards downside below 48.30, right? 48.30, that's my level to watch. I would expect it to resume its decline, retest these lows around 47 and even go farther lower down to 45, particularly if we don't have an extension in the output cut. And yes, data continues to surprise towards the upside, okay? And when it comes to gold prices, I'm still carefully watching the 200 simple moving average for today, 1248.72, right? Because it has rejected an early advance, also Fibonacci, establishing a Fibonacci high, right? Late February, right? The level reject the price. So a break above it should imply a bearish, bullish breakout beyond this height and see the commodity extend. And the fact that um, the Fed is in a rush to raise rates and that political uncertainty in Europe and Brexit and Trump in the US, it's hitting investors more, will probably keep gold bid, sorry. I was not really bullish in gold lately, but now I see more chances of an upward extension here, particularly if the 1220, 1210 area holds, right? There's not enough upward momentum in the daily chart, but in the shorter term, the commodity seems a bit more constructive, pressuring the heights, right? And so I would expect a recovery beyond 37, which is previous March 6th high, right? To confirm further gains towards 1245, 1249. That's the main bullish target I have for this week in the year. And these lows in the 1222 region are the ones I'm watching to deny the bullish extension or the possibility of a bullish extension and probably imply a bearish down corrective move towards 1210. Okay, so those are the levels I'm watching these days. Anyway, that's it for today. Hope you get something useful out of all this, and thank you, and see you back soon. Okay, bye. See you.